You are listening to Uranium Spotlight, your weekly podcast on the forces shaping the global uranium fuel market, sponsored by Purepoint Uranium Group. Uranium Spotlight isn't just a podcast, it's a platform. Visit purepoint.ca to access in-depth market briefings, sector analysis, and the inaugural Behind the Curve report, understanding when and how the uranium market turns. If uranium matters to you, you're in the right place. And now, your host, Chris Frostad.
It's May 5th, 2026, and this week on Uranium Spotlight, spot prices soften on thin activity. Your Energy restarts Shirley Basin, Lotus ramps Kayelekera, and Boss Energy shows why supply growth remains fragile. The uranium spot price opened last week at $86.45 U.S. per pound, U3O8, and closed Friday at $86.05, down 40 cents on the week. The long-term price remained at $90 a pound. Activity was limited. After two stronger weeks, the market slowed sharply with only 4 spot transactions confirmed last week. There were no reported trades on Monday, Tuesday, or Wednesday. One deal was completed Thursday, and 3 more followed on Friday, including a purchase by the Sprott Physical Uranium Trust. For April as a whole, the spot market saw 44 uranium transactions totaling about 4 million pounds U3O8. Year-to-date activity now stands at 226 transactions, totaling 23.2 million pounds U3O8 equivalent. The term market was more constructive. A non-U.S. utility entered the market seeking roughly 500,000 pounds a year from 2027 through 2031. Another U.S. utility remains active with a term request beginning in 2027, while several utilities continue to evaluate offers or conduct off-market discussions with suppliers. For investors, the key takeaway is that the spot market is quiet, but the term market continues to show steady utility interest. That matters because long-term contracting is where structural tightness usually becomes visible before it shows up in headline spot prices. UR Energy restarted mining at Shirley Basin in Wyoming last week, marking the first uranium production from the district since 1992. That is important for 2 reasons. First, Shirley Basin is historically significant. The district is often described as the birthplace of in situ recovery uranium mining, the mining method now used across much of the U.S. uranium industry. Second, this is new American uranium production coming back at a time when utilities, policymakers, and investors are all focused on secure domestic supply. Shirley Basin was formerly operated as a conventional mine by Pathfinder Mines from the 1960s until it closed in 1992, during a period of weak uranium prices. UR Energy acquired Pathfinder in 2013 and has worked since then to restart the project using ISR mining. ISR mining involves injecting a solution into uranium-bearing ore beds, dissolving the uranium underground, and then pumping the uranium-rich solution back to surface. At Shirley Basin, UR Energy uses ion exchange resin to capture the uranium before it's transported for processing. The material is expected to be processed at the company's Lost Creek facility. UR Energy CEO Matt Gilley called the launch of initial operations a pivotal achievement in the company's strategy to expand U.S. uranium production capacity. He said the restart demonstrates disciplined execution and brings a historically significant uranium district back to life. The project has a nameplate capacity of 2 million pounds a year and an expected mine life of approximately 9 years. Reserves are estimated at about 9 million pounds at an average grade of 0.22% EU308. Wyoming continues to stand out as the center of current U.S. uranium production. With American utilities looking for reliable, non-Russian supply, projects like Shirley Basin are strategically important. But they also show the scale of the challenge. Even a 2 million pound a year operation only addresses a small part of the global supply gap. For investors, this matters because Shirley Basin is a real supply addition in a market that badly needs new pounds. But it also reinforces the bigger point. The restart of individual U.S. mines helps, but it does not solve the structural uranium deficit. Lotus Resources continued ramping up its Kayelekera uranium mine in Malawi. But the latest numbers show why mine restarts are rarely smooth or immediate. The headline number looks dramatic. Ore mined increased sharply during the quarter, but actual uranium production reached only 78,310 pounds U3O8 for the quarter ended March 31st. That was only modestly higher than the prior quarter. The issue is processing. Lotus said performance was affected by reagent management, grade reconciliation, lower recoveries, planned maintenance, and capital upgrades. In other words, the mine is moving material, but the plant is still being tuned. That distinction matters. Investors often hear that a mine is restarted and assume meaningful production will quickly follow. In reality, ramp-ups are technical, operational, and logistical processes. It takes time to stabilize recoveries, manage reagents, reconcile grades, and move from mining ore to producing finished uranium. The mine is also important geopolitically. It's located in Malawi, outside Russia and Chinese control, and can potentially supply Western fuel requirements. In a market increasingly focused on origin logistics and geopolitical reliability, that matters. But the scale remains modest. The world is short tens of millions of pounds of uranium a year. A quarterly production figure of just over 78,000 pounds does not materially close that gap. Lotus has contracted commitments of 1 million pounds U3O8 for 2026 to be delivered in the second half of the year, so the company still has a significant ramp ahead. For investors, this matters because this mine is exactly the kind of mine that the market needs, but its ramp-up also illustrates why supply does not respond quickly. Restarting a mine is not the same as delivering reliable pounds into the market. Boss Energy's latest quarterly update delivered another reminder that uranium supply growth remains fragile. At the Honeymoon ISR project in South Australia, production fell to 202,781 pounds U3O8 in the quarter ended March 31st. That was down 56% from 455,791 pounds in the prior quarter. Boss attributed the decline mainly to heavy and repeated rainfall in March, which restricted site access and limited delivery of key reagents needed to maintain stable leaching conditions. The company also pointed to delays in commissioning critical infrastructure. As a result, Boss reduced its fiscal 2026 production guidance to between 1.4 and 1.45 million pounds U3O8, down from the previous guidance of 1.6 million pounds. The company's Alta Mesa project in Texas, where Boss holds a 30% interest, also saw lower production. Drone production on a 100% basis was 97,000 pounds U3O8 compared to 143,000 pounds in the prior quarter. Boss said administrative permitting delays in Texas pushed back the timing of new well fields coming online. The broader message is straightforward. New uranium supply is not just a question of price. It's affected by weather, reagent delivery, infrastructure commissioning, permitting, well field performance, and processing reliability. These are normal mining risks, but in a tight uranium market, even modest disruptions matter. This is especially important because nuclear demand is not standing still. Reactors under construction, reactor restarts, data center power demand, and national energy security policies are all increasing the pressure on the fuel cycle. The market needs more uranium, but the projects expected to provide those pounds are still proving difficult to ramp up smoothly. For investors, the key takeaway is that Boss Energy's quarter is not just a company-specific issue. It's another example of why supply growth is likely to disappoint and why the uranium market may need higher prices for longer to attract, fund, and sustain the production required.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to the latest developments shaping the uranium fuel market and its role in the global energy landscape, sponsored by Purepoint Uranium Group. While our passion for the sector is undeniable, nothing discussed here should be considered investment advice. Our mission is to provide a clear, balanced view of the forces influencing uranium prices and the nuclear fuel cycle. For deeper analysis and market briefings, visit purepoint.ca. Join us again next Tuesday for another edition of Uranium Spotlight.